Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Everybody's talking about interest rates at the moment. 24 hours ago, the US Federal Reserve, the most influential central bank in the world, indicated it could start lifting interest rates as soon as March, and several hikes are in the pipeline this year. Back home, the Reserve Bank has previously declared interest rates would be unlikely to rise before 2024, or at least the end of next year. But a surge in inflation now has many economists declaring we could see a rise as early as this year, in fact, in coming months. Gareth Aird is Commonwealth Bank's Head of Australian Economics. Gareth, welcome back to Fear and Greed.
It's nice to have a chat again.
Let's jump into the US first before we get to Australia. Jerome Powell, the head of the US Fed, has made it pretty clear that rates are rising in the world's biggest economy. Gareth, you'd agree with that?
Oh, absolutely. He certainly set the tone for the year. In a lot of ways, he said a lot of what people had anticipated him to say. I mean, it's very clear that inflation in the US has been running hot, well ahead of where the Fed thought it would be. At some point, he had to fully acknowledge that, and he did that in his press conference. It's very clear that the Fed will be raising interest rates imminently, and the house view at CBA is that we'll see liftoff in the Fed's funds rate at the next meeting in March.
Okay, financial markets have been very volatile. Does the fact that the Fed has made it clear what it's going to do, in a sense, help that volatility, or at least lessen that volatility?
Potentially. I mean, markets are moving around for a lot of reasons at the moment. The expectation of rising US interest rates is one thing driving in markets. There's some geopolitical concerns at the moment, given what's going on in Russia with the Ukraine, and markets, respond to events, and the greater the uncertainty, the more volatility to get in markets. But I think probably the big one, just in terms of where markets are trying to almost get a handle on what's going on, is that we've been in a very low interest rate environment for a very long time, and that's supportive of asset prices, in particular of the stock market. And so there is a concern that if rates end up going up too quickly, that causes some issues for equities. But I still think the US Federal Reserve will be relatively patient in what they're doing. As much as they probably don't talk about it, they would be concerned around their actions causing too much negative impact on asset prices. And so I think when they get around to raising rates, I think they'll try and sort of manage it so that they're not causing too much disruption to financial markets in particular.
Okay, so let's bring it home. The big question for most of us people with a home loan or a car loan or a personal loan, pensioners who need income, when will the Reserve Bank increase the official cash rate?
Oh, well, it's a very good question, and it's one that every sell-side economist right now is trying to answer. Everyone was aware that all through last year, the Reserve Bank was flagging the idea of an increase in the cash rate as being a long time away. They were either talking about early 2024 or potentially late 2023 as the time they thought it most likely that they would raise the cash rate. And we were never convinced on that, basically because our view is that they have been underestimating the potential for higher inflation in Australia to come through, and in turn, higher wages growth and a tighter labour market. So their forward guidance on the cash rate was always kind of predicated on their view on inflation and employment. And as it turns out, the data has been coming in a lot stronger, particularly around inflation, than they've been expecting. So it's our view at CBA that August this year is the most likely time now for an increase in the cash rate. That obviously, it sounds like a time which is very different to what the Reserve Bank has been talking about. But in the inflation data that we got out this week, what we saw is that inflation pressures here in Australia are running a lot hotter than the Reserve Bank had been expecting. So next week we hear quite a bit from the Reserve Bank. There's a board meeting, there's a speech by the governor, and then the statement of monetary policy. And I think after that communication, we'll have a lot better sense of what the Reserve Bank is now thinking around the cash rate. But they're going to need to acknowledge, I think, that they haven't actually read the inflation outlook correctly.
Okay, so notwithstanding we have that next week, the figures this week, headline inflation was 3.5%, underlying 2.6%, which the Reserve Bank tends to focus on. In 3 months' time, if we get similar numbers, so let's say we get 2.6% for underlying inflation, that means that underlying inflation is well and truly in the Reserve Bank's target band. Is that enough to push them, or does it need to be outside the band?
Well, they're looking for a few things at the moment. They're looking for inflation to be, and this is the words that they're using, sustainably within the target, so around that midpoint of the band. So they've said they don't want to see it just get there. They want to be comfortable that it's going to stay there. And for them to be comfortable that it'll stay there, they want to see higher wages growth as well. And I think they're going to see that. We get a wages print in the middle of February, which I think will show that wages pressures in Australia are accelerating because the labour market is so tight. The unemployment rate in December was down at 4.2%, which was its lowest level since 2008, and that bodes very well for wages growth. So I think they're going to see that. It's probably worth just flagging too in terms of where underlying inflation is right now in Australia. The annual rate is 2.6%, but if you look at the last two quarterly rates, so in other words, Q3 and Q4 of last year, and then you take those two rates and as a 6-month annualized rate, what you find is that inflation in Australia is more like 3.5%.
Wow.
So there's been a clear acceleration in the rate of inflation over the second half of last year. And within that annual calculation, the annual rate at the moment, you've got some pretty low numbers from the first half of 2021. So they will drop out in coming quarters, and then it's going to be very easy then for underlying inflation to actually be sitting at the top of the Reserve Bank's 2 to 3% target band.
Stay with me, Gareth. We'll be back in a minute. I'm speaking to Gareth Aird, Head of Australian Economics at the Commonwealth Bank. Let's talk about wages. Over summer, everywhere I went, holidays around where I live, people didn't have staff, and so often you couldn't sit down in a restaurant, you could only get takeaway. There were limited menus. I've got to say, I actually went to one of the major banks, we'll call it the Commonwealth Bank, and they were having staff shortages in the branch. We were sitting down to look at a personal loan for one of my kids, and they said, look, we'll help you, but it's just difficult at the moment with staffing. It's affecting everyone, it seems.
Look, it is, and there's a couple of things going on. The one is the direct impact of COVID on the labour market, where people have either got the virus and so they're isolating, or they're a close contact and they're in isolation, and that's causing significant short-term disruption on the labour market. But if we take a step back from that, particularly if we look at where things were in December before we really had a lot of COVID disruption on the labour market, the unemployment rate, as I said, was very, very low, and the underemployment rate, which flies under the radar a little bit, but it's measuring the people out there that have a job but are looking for more work, that's also at its lowest level since around 2008. So even before the COVID disruption that's come about through isolation and illness, the labour market was looking very, very tight, and that bodes really well for wages growth. We haven't to date seen too much of an acceleration in the official wages data, but I would add that the official data, the most recent print, is for Q3 of last year, and half of the country was in lockdown through that September quarter. So I think what we're going to see is quite a lift in wages growth from here, given the tightness in the labour market. Our internal data at Commonwealth Bank, which is capturing money that's being paid into CBA bank accounts, when we make a few tweaks to account for changes in hours work and people moving jobs, it's suggesting that wages inflation did actually accelerate quite materially over the back end of last year, and it should only continue to pick up this year given that tightness in the labour market. So I think a lot of the anecdotes and reports you see and floating around the media around significantly higher pay for people washing dishes and construction workers and the like, I think we'll start to see some of that bear out in the official data. And again, that's all going to be sort of supportive of the idea that the Reserve Bank will end up normalising rates much earlier than they've been telegraphing.
Okay. So if that happens and we get an interest rate increase in August and potentially one later in the year, what's it mean for other parts of the economy? So I would like to ask you about the housing sector. I'd also like to ask you about businesses. Do businesses not want an interest rate hike, or is it just the fact that it actually shows that the economy is doing better?
Look, they're good questions, and there are winners and losers to interest rates either going up or down. What we do know is that from a business perspective, business borrowing is not particularly sensitive to interest rates. Businesses will borrow if they think that demand is going to be strong in the economy, and businesses are generally borrowing to invest. And small movements in interest rates don't generally change a business decision around investment. The interest rate sensitive part of the economy is really the household sector, and that flows through obviously to the property market. So for people that are on floating mortgages, when interest rates go up, they will experience an increase in their mortgage repayments, assuming that they're repaying the minimum. I mean, if as interest rates were coming down, if a borrower was on a floating rate but they left their dollar repayment the same, then what actually would be happening is they would be paying more in principal each repayment and less in interest, and therefore as rates go back up, their repayments may not actually change. It would just be the composition of the payment that would be changing in terms of interest versus principal. But for anyone who's paying the minimum on their home loan at the moment and is on a floating rate, as soon as the standard variable rate goes up in response to an increase in the cash rate, well, they will find that they are paying a little bit more each fortnight or quarter to pay off their home loan because the interest cost has gone up. So that then in turn acts to slow the economy a little bit. And that ultimately is what you're trying to do when you're raising interest rates. It's a recognition that the level of interest rates that you currently got is not the right settings based on where the economy is. And therefore you tweak rates accordingly to generate the economic outcomes you're looking for. And so when we think about what the Reserve Bank will be trying to do when they get around to raising interest rates, they won't be trying to take the cash rate from a stimulatory setting to a contractionary setting. What they'll be trying to do is taking it from a very stimulatory setting to a normal setting. And we think that means it's still a very low interest rate just based on how much debt the household sector in Australia carries. But it will be a rate which is obviously higher than where it is today. We think it's probably around a cash rate of 1.25%, which means you're probably looking at a little bit over 100 basis points of increases to the cash rate to get policy to what we would sort of say is a normal setting. Could turn out to be the case the Reserve Bank has to go beyond that, but that would only be if the economy is running so hot that they're actually trying to run contractionary policy to really pull it back.
Okay, and then in a sense, we hope that's not the case. We are at very low interest rates at the moment, actually going up 100 basis points. For most of us, outside the last 2 years, that's still a relatively low interest rate.
Yeah, look, that's exactly right. And a lot of this, where we end up in some sense, will come down to the timing of when the Reserve Bank starts. I mean, ideally, if they get their policy settings right and they move at the right pace, then they won't actually need to go beyond that point where they're running contractionary policy, because they will be normalising the cash rate at a rate which is sort of appropriate for where the economy is at the moment. That's our expectation, that they'll just end up at that place. You know, we shouldn't forget that we have a federal election coming up, and it's possible that the Commonwealth government, whoever that turns out to be after the election, wants to spend a lot more money than is currently baked in, and that could mean, you know, interest rates end up higher than neutral. But at the moment, it's probably just worth thinking about that as a risk to the outlook, as opposed to what would be your central scenario.
Gareth, we've almost made the whole interview without mentioning COVID, which is quite incredible. But of course, Omicron and COVID, is that still the big risk to the economy?
Look, it's still the big risk in terms of disruption, but I think by and large the news has actually been pretty good on it so far this year. And I know that might sound a little bit odd given we've had the explosion in cases, but by all accounts, cases have peaked. The hospital system around the country has coped relatively well. It's caused obviously a lot of disruption, but you know, I think we're already moving through to the other side. And one of the things that is an encouraging sign for me on that front is our internal data at CBA relating to spending on credit and debit cards. That slowed quite a bit at the end of last year and the first week or two of this year. But in the last couple of weeks in January, it's actually picked up quite a bit. So I think really what it was capturing is just the impact of people being in isolation on spending. But as soon as they've been able to get out of isolation, they're back out spending. And I think we're going to find that the COVID disruptions will dissipate as we go through this year.
Let's hope so. Gareth, thank you for talking to Fear and Greed.
It's lovely to have a chat.
That was Gareth Aird, Head of Australian Economics at the Commonwealth Bank. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.